Welcome to This Explainer. Today we are going to tackle what might literally be the ultimate financial dilemma. It's an argument that has honestly ruined perfectly good dinner parties and sparked endless debates. Should you invest your hard-earned money in real estate, or should you put it into the stock market? People have incredibly strong opinions about this. Some will swear up and down that real estate is the only true path to wealth, while others are totally convinced the stock market is the ultimate passive income machine. But today, we aren't looking at opinions. We're looking directly at the cold, hard math.
So who actually makes more, the landlord or the index fund investor? I mean, it sounds like a pretty simple question, right? But the truth is, most people who try to answer this completely forget to count the actual hours they spend working, or they totally forget to calculate the compounding zeros. To find the real mathematical truth, we're going to set up a rigorous 20-year timeline and track exactly what happens when you fully commit to either path.
Okay, let's dive into this. To keep everything completely fair and, scientifically accurate, we need a control group. So meet Jake and Marcus. They are starting at the exact same starting line. They both have $50,000 saved up. They both earn a salary of $55,000 a year. They're the exact same age, living in the exact same city. They represent the exact same financial starting point. Literally, the only difference between them is what they are about to do with that 50 grand.
Now, here is where their paths completely diverge. Jake decides to leverage his $50,000 as a 20% down payment on a $250,000 rental property. It's a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at a 7% interest rate, which gives him a monthly mortgage payment of about $1,330. And he quickly finds a tenant willing to pay $1,800 a month in rent. Marcus, on the other hand, takes a completely different route. He drops his entire $50,000 into a total stock market index fund. No leverage, no tenants. He sets up an automatic, completely boring contribution of $300 a month, and, well, he just goes back to his life.
Think about Jake's day one feeling for a second. It is absolutely incredible. He can literally drive past this house, point out the window, and tell his friends, "I own that." On paper, if you subtract his mortgage from his rent, he has a $470 a month profit before he's even lifted a finger. He's claiming mortgage interest and depreciation on his taxes, he's building tangible equity, and let's not forget the social proof. At dinner parties, he has a house, a tenant, and a great story to tell. He honestly feels like a financial genius.
But contrast that completely with Marcus's day one. Marcus gets a confirmation email from his brokerage account, and that is it. His coworkers ask him what he's investing in, he says index funds, and they just kind of nod politely and change the subject. There are no keys in his pocket, there are no tenants texting him, the asset is entirely invisible. It's literally just a number on a screen that goes up a little, down a little, and up a little more. Emotionally, it feels like Jake is winning by a mile. But as we'll see, feelings and math are two very different things. Now, let's completely shatter the illusion of Jake's initial success. His napkin math over 3 years shows a gross cash flow of nearly $17,000. Sounds amazing, right? But then, real life hits. Property taxes are $3,000 a year. Insurance is $1,500. A sudden roof leak costs $2,800. Oh, and the water heater dies? That's another $1,200. Plus, the property sat vacant for a month, costing him $1,800 in lost rent, and another $600 just to clean and relist the place. So Jake's actual net cash flow over 3 years is a mere $2,000 to $4,000. And remember, that doesn't account for a single hour of his time managing all these headaches.
But wait, before you count Jake out, you really have to understand the ace up his sleeve. And that is leverage. Leverage is using borrowed capital, the bank's money, to completely multiply your potential returns. Even though his cash flow is tight right now, Jake used his initial $50,000 to control an asset worth $250,000. Over these first few years, that property has appreciated by, let's say, 3 to 4% annually. That means his equity, the house's value minus what he owes on the mortgage, has grown to between $55,000 and $65,000. He is building real wealth using someone else's money, and that is a massive advantage.
Meanwhile, Marcus is relying on his own superpower: compounding. Compounding is essentially what happens when the returns on your investment start generating their own returns. By year 3, Marcus has his initial $50,000 plus the $10,800 in his steady monthly contributions. Earning a historical average of about 10% annually, his portfolio is now sitting at roughly $76,000. And honestly, the best part? He has spent absolutely 0 weekends sacrificing his free time to fix a leaky faucet or coordinate with repairmen.
Let's pull back the curtain on real estate for a second. The rent check is the number everyone loves to brag about, but there are unseen enemies quietly eating away at that money. On average, you have to expect about 1 month of vacancy a year. You have to budget 1 to 2% of the property's value for routine maintenance. And capital expenditures, or CapEx, those are guaranteed future costs. We're talking about a $7,000 HVAC replacement in the middle of August that you just can't postpone. If you hire property management, you lose 8 to 10% of your rent immediately. If you don't, well, you just bought yourself a part-time job. And bad tenants? A single eviction can wipe out 6 months of rent. By year 5, factoring all this in, Jake's actual cash-on-cash return is hovering around a very modest 3 to 5%.
Now let's see how this builds for Marcus. Under the surface of his completely boring wealth machine, something incredible is happening. Notice how his wealth curve starts off quite slow, but by year 7, it's jumping to around $140,000. By year 10, it's aggressively accelerating up to $180,000. This is what compounding does. It is painfully boring for the first 5 years, and absolutely astonishing for the next 15. The gains on his gains are now generating more wealth than his actual monthly contributions, and he is still doing absolutely nothing.
This brings us to a massive turning point. Year 10. Look at how surprisingly close their net wealth is right now. Jake is sitting on roughly $170,000 to $184,000 in equity. But that came with $20,000 to $35,000 out of pocket for repairs, hundreds of thousands of dollars in debt, and hundreds of hours of high stress. He is highly concentrated in one single asset in one zip code. Marcus, on the other hand, is sitting on up to $180,000. It cost him $36,000 in slow, steady contributions and absolutely 0 hours of work. He is globally diversified and hasn't lost a single night of sleep.
And here is the jaw-dropping 20-year reality. 2 decades later, Jake's property is essentially paid off. After 20 years of taxes, insurance, repairs, and tenant turnover, his net worth from this asset is between $400,000 and $500,000. Now compare that to Marcus. With his initial $50,000 and just $122,000 in total contributions over 20 years, the rest is pure compounding. He is sitting at $420,000 to $460,000. They're in the exact same $500,000 ballpark. But how they got there couldn't be more fundamentally different.
And this brilliantly illustrates the real power of liquid markets. We call it the $200 multiplier. If Marcus had simply decided to increase his monthly contribution by just $200 along the way, his 20-year portfolio would jump to nearly $600,000. Because of compound interest, small additions have a massive multiplied effect. For Jake to dramatically increase his real estate wealth, he can't just add $200 a month. He has to take on another massive mortgage, buy a whole second property, and completely double his workload.
But we have to remain impartial here, because stocks absolutely have a dark side. Negative 37%. That is roughly what the stock market dropped in 2008. In March 2020, it dropped 34% in a single month. If Marcus had $150,000 in his account, watching it suddenly plummet to $95,000 in a matter of weeks is gut-wrenching. It's no longer just a number on a screen. It's terrifying. The brutal volatility of the stock market is exactly what causes most retail investors to panic sell and lock in their losses at the absolute worst possible time.
Real estate also absolutely dominates in a few specific mathematical situations. Index funds don't give you monthly cash flow. Dividends are a mere 1.5% to 2%. And stocks definitely don't give you leverage. But in real estate, if you have a strong rent-to-price ratio from day one, you win. If you utilize house hacking, living in one unit while renting out the others to cover your mortgage, you win. If you use 1031 exchanges, you can literally roll your profits from one property into a bigger one entirely tax-free. And of course, depreciation acts as a massive legal tax shelter that stock investors simply do not have access to.
So the crucial point is this. Jake worked for his wealth, taking on risk, stress, and illiquidity. Marcus waited for his wealth, enduring brutal volatility in exchange for complete freedom and liquidity. The real trap isn't choosing real estate or choosing stocks. No, the real trap is picking one of these paths based entirely on hype, a catchy headline, or something someone bragged about at a barbecue, without ever sitting down and running the full, true math for your own life and your own risk tolerance.
Which leaves us with this final, vital question. The next time someone passionately claims to you that real estate always wins, or that the stock market always wins, ask them this. Did you include everything? Did you include the hours, the taxes, the sudden repairs, the compound growth, the emotional stress? Because when you are planning the next 20 years of your financial life, the only answer that actually matters is the one that accounts for all the variables. Keep learning, keep running the numbers, and we'll see you in the next explainer.